Gold just sent a warning the system can't take back because assets that are designed to move slowly just broke into a full sprint. Gold didn't climb, it ripped through its historical ceiling, blasting past $4,700 an ounce, marking its strongest run since 1979. Silver didn't lag behind. It surged more than 5% in a single session, exploding toward levels most traders never modeled. Here's the paradox. This isn't happening during economic confidence. It's happening during tariff threats, geopolitical escalation, and policy chaos. Safe havens aren't reacting calmly. They're behaving like escape hatches. And if you earn, save, or plan your future in any currency, this is aimed directly at you. Because when gold and silver move like this, it means investors aren't chasing profit. They're pricing in risk that no one wants to say out loud yet. Notice what's missing from the headlines. No one is calling this a panic. No one is explaining why buyers are suddenly willing to pay any price to get out of the system, because the real story isn't the rally you're watching. It's the trigger behind it. And once you see what set this off, you'll understand why this move may not stop where people expect. What you're seeing right now didn't come out of nowhere. The rally started with a single shock, but it didn't stay isolated. According to the material, markets reacted sharply after the United States escalated trade threats in a way few expected. A proposed 200% tariff targeting France, alongside similar threats aimed at Germany and the UK, tied to disputes involving Greenland, landed like a grenade in global markets. That's a specific trigger, not background noise. But here's where the framing matters. This wasn't just a policy disagreement. It was the weaponization of trade against allies. When the issuer of the world's reserve currency signals it's willing to use tariffs this aggressively, even inside its own alliance system, trust starts to fracture. Now watch the pattern. Each time uncertainty spikes, money doesn't wait for clarity. It moves first. And this time, it didn't move into stocks or bonds. It moved into assets that don't rely on promises, treaties, or policy reversals. Ask yourself this question. If this were just about inflation or growth, would gold and silver be moving at this speed? Or does this look more like a market reacting to something it believes could spiral fast? Because this is where the story stops being about prices and starts being about confidence. Here's the strong claim markets are making right now, whether they admit it or not. This move isn't being driven by optimism. It's being driven by fear of policy instability. Look at the evidence. Gold didn't just edge higher. It surged roughly 63% year to date, its best performance since 1979. Silver went even further, jumping more than 5% in a single session and adding over 70,000 rupees in just 11 trading days. Those are not normal inflows, that's urgency. And here's the detail that changes how you read the chart. While screen prices exploded, the physical supply chain started to crack. Refiners delayed payments to dealers by 7 to 10 days. Some were offering to buy silver at $15 below spot. That's a disconnect that shouldn't exist in a healthy market. Notice what's missing from official explanations. No one is addressing why intermediaries suddenly refuse inventory risk while prices scream higher. No one is explaining why liquidity is evaporating exactly when demand peaks. This is where the story flips. Because when paper prices surge but physical systems strain, it suggests buyers aren't speculating anymore. They're rushing to secure exposure before access tightens. And once that behavior sets in, the market stops listening to models. Now watch how fast this escalates. Once prices break psychologically important levels, behavior changes across the system. What looked like a rally starts behaving like a stress test. Dealers aren't just busy, they're overwhelmed. Order volumes spike 40% week over week. Some report their fourth highest sales week in history. And this isn't institutional desks quietly reallocating. This is retail flooding in. Here's the comparison that matters. In past cycles, like the late 1970s or the 2011 spike, metals rose alongside clear inflation narratives. Today, the narrative is messier. Tariffs, sanctions, fiscal drift, alliance fractures. There's no single explanation, and that's exactly the problem. Notice what's becoming normal. People with no prior interest in metals are suddenly asking how to buy. High school acquaintances, casual investors, even retirees liquidating long-term accounts to chase silver. That's not strategy, that's capitulation. This is where the market crosses a dangerous line. When fear-driven buying becomes socially validated, speed replaces caution, and once that happens, systems designed for steady demand start to fail under pressure. What you're watching isn't just prices moving up, it's a market adapting to panic in real time. Here's the evidence that permanently changes how this rally should be read. As demand surged, the system didn't just strain, it started rationing. One of the largest bullion dealers in the market imposed a $500 minimum just to place an online order. To sell metal back, the minimum jumped to $10,000. That's not marketing, that's crowd control. Now pause on that contradiction. A retailer whose job is to move product is actively slowing transactions while prices are at record highs. That only happens when operational capacity breaks. Minting, packaging, shipping, settlement, all of it hits a wall at once. And here's the line most people miss. Silver is supposed to be the poor man's gold, but when minimums rise and access tightens, that safety valve closes. The very people rushing in are suddenly priced out of participation. Notice what they didn't say. No reassurance about inventory. No timeline for normalization. No denial that the system is overwhelmed. This is where perception shifts. Scarcity stops being theoretical and starts being experienced. And once people believe access can disappear, price becomes secondary. Because at that point, the question isn't is it expensive, it's will it still be there tomorrow? What happens if this continues? Because now the pressure starts stacking fast. First, refiners delay payments by more than a week, forcing dealers to carry risk they didn't plan for. Then physical premiums swing wildly, with some buyers paying far above spot, while others are offered prices far below it. At the same time, local governments step in and make things worse. In Washington state, a nearly 10% sales tax on bullion kicks in, and buyers respond immediately by driving hours into Oregon just to avoid it. That's 3 stress points hitting at once. Liquidity slows, pricing breaks, capital starts fleeing across borders, even state borders, in search of frictionless access. Now watch how quickly control slips. Dealers can't smooth volatility. Regulators can't stabilize behavior, and buyers don't wait for clarity. They move wherever resistance is lowest. This is the danger zone for any market. When speed overtakes structure, small policy changes trigger outsized reactions, and once that dynamic locks in, reversals don't come gently. So ask yourself this: if pressure keeps stacking like this, does the system regain balance, or does something finally give? Now bring this down to where it actually hits you. Because this isn't happening in trading terminals or policy rooms alone. It's happening in ordinary decisions. People cashing out retirement accounts earlier than planned. Families delaying purchases because prices feel unstable. Small dealers forced to turn customers away, not because demand is weak, but because supply can't keep up. If you've ever felt that quiet pressure to do something with your savings, this is where it comes from. When assets meant to preserve value start moving violently, confidence erodes. You stop trusting price tags, you start questioning timing, and suddenly standing still feels riskier than acting. Notice how ideology disappears here. This isn't about politics. It's about lived consequences. Access gets harder. Costs rise unevenly. Those who move early feel relief. Those who hesitate feel exposed. And this is why these moments spread socially. Friends talk, group chats light up. Someone always says, I should have done this sooner. If that feeling sounds familiar, say so in the comments, because this pressure isn't unique to you, it's systemic, and once enough people feel it at the same time, the market doesn't need a catalyst anymore. To understand why this keeps happening, you have to look past emotion and into the machinery. Markets don't move like this by accident. They move when incentives line up. Right now, the incentive structure quietly rewards one behavior and punishes another. Holding cash earns little while carrying rising policy risk. Holding bonds assumes stability that no one is promising. Holding metals requires no permission, no counterparty, no faith in reversals. Here's the unsettling insight. This isn't panic-driven chaos. It's rational adaptation. When rules feel flexible and enforcement feels selective, capital doesn't argue. It exits. Notice how spectacle plays a role. Every tariff threat, every sanction, every policy surprise amplifies uncertainty without resolving it. That uncertainty becomes leverage, and leverage forces portfolios to rebalance defensively, even if no one says that out loud. This is why mainstream coverage struggles to explain it. There's no villain, no single headline, just a system that quietly nudges behavior until enough people respond at once. Once you see that mechanism, the rally stops looking emotional. It starts looking structural. And structural moves don't unwind on sentiment alone. From here, the path forward splits, and neither option is comfortable. One possibility is stabilization. If geopolitical pressure eases, if tariff threats de-escalate, if policy signals regain coherence, momentum could slow. In that scenario, stretched positions unwind. Silver in particular could see a sharp correction, the kind that wipes out late entrants and restores a sense of normalcy. History says moves this vertical don't cool gently, but there's another path, and markets are clearly hedging for it. If uncertainty persists even without a new shock, behavior doesn't reset. It compounds. Central banks continue accumulating. Institutional capital keeps rotating in. Physical bottlenecks don't resolve overnight, and each pause becomes a platform for the next leg higher. Here's the key tension. Nothing dramatic has to happen next for this to continue. Momentum alone can carry it forward, once enough capital is committed. That's why this moment feels unstable. The next move isn't being debated. It's already forming through positioning, and whichever path emerges, it won't announce itself in advance. Here's the insight that ties all of this together. This wasn't a story about metals breaking out. It was a story about trust breaking down. Gold and silver didn't change. The environment around them did. When systems feel predictable, these assets stay quiet. When systems feel improvisational, they start screaming. That's why this move feels different. It isn't chasing growth, it's defending against surprise. And once enough people make that shift at the same time, prices stop reflecting value and start reflecting urgency. The real question going forward isn't whether gold or silver are too high, it's how many people still believe the old rules will reassert themselves. Because if they don't, this isn't the end of the story. It's the opening chapter of a longer realignment that most people won't recognize until it's already reshaped their choices. If you want to stay ahead of that curve, follow and subscribe. The next layer of this story is already moving.